If you're managing a team, you are definitely feeling the pressure of rising healthcare costs. But what's really on the horizon? Well, we're going to dive right into Aon's 2026 Global Medical Trend Report to pull out the key insights you need to get ready for what's next. So let's just start with the headline number, 9.8%. That's the big global medical trend rate that's projected for 2026. Now, on the surface, you might think, hey, back to single digits, that's a relief. But honestly, that number, it doesn't tell the whole story, not even close. It's hiding a much more complicated and turbulent picture, which we're about to unpack. Okay, so before we go any further, there's one really key idea we have to get straight. When we talk about medical trend, we're not talking about the total dollar amount. We're talking about the speed of the increase. So think of it this way. Even when the trend goes down, costs are still rising. They're just not rising quite as fast. Getting that difference is totally crucial to understanding what's really going on here. Right, so if 9.8% is just the average, what's actually happening where you are? This is where things get interesting, because the real story is in the details. We're seeing huge differences from one part of the world to the next, and this is where that simple global number really starts to fall apart. And here is that turbulence in living color. Just look at the difference here. You've got the Middle East and Africa bracing for a massive 15% jump, while in Europe, the rate is almost half of that. This isn't one single global story. It's a bunch of completely different regional dramas playing out all at once. But it's not just about the final number. It's about which way the wind is blowing. While that global average is slowing down, places like North America and the Asia-Pacific region are actually seeing their cost growth speed up. Everybody else, they're slowing down, even if their costs are still high. It just goes to show you how fragmented this whole picture really is. So what's causing all these different movements? Well, in Europe, you've got cooling inflation and a big slowdown in the UK helping to bring that trend rate down. Over in Latin America, changes in how care is delivered in countries like Brazil and Colombia are making a difference. And then you have the Middle East and Africa, which is a wild ride. The main number is down, but when you factor in inflation, the actual cost pressures are going up, super volatile. Okay, so we've seen the numbers and the regional drama, but what's really driving all of this? Let's peel back the next layer and look at the specific medical conditions that are putting all this pressure on the system. So the top drivers are probably what you'd expect, right? Cardiovascular disease, cancer, these are the usual suspects. But look at what's new on the list at number 5, musculoskeletal issues. That is a huge shift. It reflects this global increase in conditions affecting our bones, joints, and muscles. And it's adding a whole new layer of cost for employers everywhere. And of course, these conditions don't just pop up out of nowhere. You can trace them back to these underlying risk factors. High blood pressure is a real double whammy. It's a major condition on its own, and it's the #1 risk factor for other issues. And it's no surprise to see lifestyle stuff like physical inactivity, poor nutrition, and obesity right there behind it. Now, we have to stop and talk about a massive new variable here, a true game changer that's completely rewriting the rules for drug costs. I'm talking about the explosion of GLP-1 therapies. Just to give you a sense of the scale we're talking about, think about this. What single new type of treatment could possibly be responsible for a full quarter of all medical cost increases in some markets? The answer is a class of drugs I'm sure you've heard a lot about, GLP-1s. This is incredible. Where these drugs are actually covered by company plans, they are already responsible for an average of 10% of the entire medical trend rate. That is a gigantic impact from just one family of medications, and it's forcing companies everywhere to completely rethink how they handle pharmacy benefits. So, how are companies trying to deal with this? Well, the main strategy right now is to draw a pretty firm line. They'll cover these drugs for someone with diagnosed diabetes, but not just for weight loss. It's a way to try and stop the cost explosion. But, as the report points out, with diabetes itself on the rise, this is probably just a temporary fix. All right, so you're faced with all these powerful cost drivers, from chronic conditions to these blockbuster drugs. What are leading employers actually doing to get a grip on the situation? Let's open up the playbook. And let's be clear, this isn't just a side project. This is now the main event. For a massive 70% of multinational companies, managing costs has become the absolute #1 priority for their benefits programs. That kind of intense focus is driving a real hunt for smart, effective solutions. So what are these companies actually doing? Well, the strategies really fall into a few buckets. First, you've got the financial pressure. negotiating hard with vendors, putting contracts out for bid to find new ones. Then there's the proactive approach, investing in well-being initiatives, offering flexible plans. And of course, there's the big push into tech with virtual care like telehealth. And there's a really good reason those proactive strategies are so popular. As Catherine Davis from Incon says here, well-being initiatives are number one because they get ahead of the problem. It's all about encouraging preventative care now so you can avoid much more expensive treatments later on. It's just a smarter way to play the game. And that really brings us to the final, most important question. We've seen a world where chronic conditions are rising, disruptive new drugs are here, and there's intense pressure on costs. The strategies that worked 5 years ago, they just might not be enough for what's coming. So as you look forward, you really have to ask yourself, is my benefit strategy built for the past, or is it truly ready for the future?